when Google started doing what Google does, and when Apple started doing what Apple does in particular, and then you throw Amazon into the mix, everybody's expectations started to change. We now, as I said, don't want to go to a branch. We don't want to necessarily have to speak to a person, and we certainly don't want to have to wait for 9 till 5 Monday to Friday. We want it always on, we want it whenever we want it, we want it instantly. So, 2008 happens and the UK banking landscape gets really shaken up. The banks that can't survive, there are banks that disappear, there are brands that appear and reappear, there are, government mandates. But it's really, as I said, a catalyst for change, and it's really a starting point for what happens next. And what happens next is we see a huge change in the landscape. We move away from that kind of branch-based banking system. We move away from kind of the domination of those few big banks that I listed, a few big brands even. Bank brands? Try saying that very quickly. So we start to move away from that. And as I said, 2008 is one driver, but there are actually three main drivers that contribute to the change that we saw over the next 12 years. So the first one, which I've mentioned briefly already, is regulation. Now, after 2008, governments and regulators looked around and went, well, we can't have that again, can we? That was a terrible situation. It was very complicated to solve. Everybody was very unhappy with this, and a lot of people lost a lot of money. So let's try and prevent that happening. Now, some of what they did, as I said, was instructing the big banks to be broken up, to sell assets off so that they were more manageable. We move away from this idea of too big to fail. We start to introduce more bank brands to customers, because the idea being that the more banks there are out there, the more choice people have, and then the banks will have to work harder to be better banks, basically, because they've got more competition. So some very specific things that happened in the UK that were really important in driving these changes. Well, the first one was that we got rid of our regulator. So the FSA was no more. The Chancellor at the time, George Osborne, thought, we've had enough of them, thank you very much. That didn't work. Let's try something different. And so what we ended up with was coming from the FSA. We had the PRA and the FCA. Now, the PRA is the prudential regulator, and the FCA is the behavioural regulator, if you like. They are checking on the conduct of banks, so they're the Financial Conduct Authority. And by breaking this down, the thought was that these two agencies would be able to focus more specifically on different aspects of the banking industry, and therefore perhaps have more resources, more energy to maintain those two very important sections of bank licensing. Now, the PRA is interesting, but the bit that we're interested in today, because we're talking about retail banking, is the Financial Conduct Authority. Now, the Financial Conduct Authority, when it was formed, was given a mandate to ensure that there was competition in the retail banking market, also to ensure that customers were fairly treated at all times by those banks. But this mandate of competition was really, really important because it gave it the impetus, the drive and the power to do things that perhaps other regulators had never been able to or wanted to be able to do before. So what they did was set up what's called an innovation unit. It's an innovation hub, actually, I think they call it. To encourage people playing in the financial services market, people who wanted to play in the financial services market, to come and talk to them, to tell them what they wanted to do. Because the FCA wants competition, but it can't do it on its own. It needs people to set up those new banks. It needs people to start those banks. The best way to do that is to talk to them, it decided, to bring them in and to let them experiment and to let them play. So the Innovation Hub is the name, or the broader name, for a huge number of initiatives that the FCA has since launched. One of the most famous of which is its sandboxes, which, as I said, let the innovators come and try things out, basically, without needing to be licensed to start with, or without having to have that full license in place, and also without any danger to customers, because they're playing within the regulator's bounds. The other really important thing that happened was actually in partnership the PRA, the FCA, and the Bank of England. So these three big regulators, and they're still the big regulators today, thought, right, all of this is great. We're encouraging innovation. We're talking to people. We know what they want to do. How are they going to do that? Because right now, setting up a bank is really, really expensive. It's hard. You need lots and lots of money. So if we go back to when we were talking about the reserve banking system, you have to have money in your bank. You have to have capital. So that if all those people who've deposited money with you at once come and say they want it, you've got to be able to pay them back. And that's no good if you've lent it all out to somebody else. It's a very, very basic summary. But, it comes down to the fact that starting a new bank was very expensive. So these three regulators thought, what can we do about that? I know, we'll set up a new banking unit. And the new bank unit, is designed to do exactly that, to encourage new banks into the UK market to facilitate that competition mandate and to facilitate innovation. And, whilst the new bank unit was great, you could go and talk to the regulator, they'd talk you through it, they'd guide it. They also actually made it cheaper. They agreed to reduce the amount of capital you needed to start a bank. And that meant you could get going with before you'd accumulated all that money. You could start trying ideas. You could innovate as you go. You could iterate. And so they were borrowing ideas from what they were learning from the ecosystem around them. And what that meant was that you could get now what they called a restricted license. So you'd go to these three, you'd go to the new bank unit, you'd apply for a restricted license, you'd say, this is what we want to do, this is how we're going to do it. You'd sit down with the regulator, you'd talk them through it all, you'd reassure them, and they'd say, okay, here you go, here's your restricted license. And to have that license, you need far less capital than you do to need a full license. But you've got to prove to us that you can get from that restricted license to a full license in a reasonable period of time. Generally speaking, that's about a year to 2 years. There is a date set on it when they get the restricted license. But whilst they have that restricted license, they can start serving customers. So the number of customers they can serve are limited. They can only hold a limited amount of deposits, but it means that they can actually get out there. They can actually start serving customers. They can find out what those customers want. They can find out what those customers need. And if the first thing they launch isn't quite what customers want, well, they've got a bit of time to play with it. And because they're not having to focus all their attention on holding and raising this capital, they have slightly more energy and resources for innovation. And so this regulatory piece was hugely, hugely important in the UK and led to the creation of, I believe it's 18 new banks since it was set up, which is a huge number. And those banks, serve small businesses, they serve customers, but they really, really helped stimulate the UK retail banking industry. And, those names that we all know and love now, Monzo, which has got over 4 million customers, you've got Starling Bank, they wouldn't have existed without this. So this regulatory piece was a huge driver of that ongoing change. But regulation doesn't work on its own. It all sounds well and good talking about innovation and saying, okay, we'll give you a license that you can work on restricted with limited capital, but how are you going to go away and build that bank? Because we've already talked about the fact that we have cut back on the number of branches. And by the way, branches are really expensive to maintain. You've got to pay rent. You've got to pay people to staff them. You've got to pay for the heating and the water. So let's try and move away from that. And the banks in this unit went, yeah, we can do that. We'll just use technology. Technology from around 2008 onwards, was in a great place for this. There were 4 key elements. So we had cloud-based technology, we had APIs, we had smartphones, and we had the internet. Now, I know that cloud-based processing and the internet had been around a long time before 2008. But at this point, there was this perfect storm of these 4 technologies that allowed banks to take the permission they'd been given and go away and do something with it. So cloud-based is important because it means you don't have to pay for a huge legacy banking core system. You can use it as and when you want. You can use processing power as and when you want. So you can draw down if you need more now, you can pay less if you need less right now. And it means the upfront investment, again, is a lot lower. So again, it's a lot easier to start a new bank. And it means you have more people trying and more people succeeding. Then you have APIs. We won't go into those too much today. I could do a whole other session on those. But basically, API connectivity, again, APIs have been around for a long time. But what started to really be more prevalent within the technology industry as a whole, not just finance, is open APIs. And those were APIs that anybody could use to connect to different systems. And they're particularly noticeable from the likes of Google, the likes of Uber. So APIs is what Uber used to build a system that allows you to have one app, but it also has a map in it from Google and a payment system in it from another provider called Braintree. So Uber wouldn't work without open APIs because it needs all those elements to come together. And what that means is that Uber doesn't have to build those elements or pay for those elements, as it were. It just accesses them through these open APIs. And yeah, sure, we're paying some kind of access fee, but far, far cheaper than trying to do it all from scratch. And banks did the same thing. They started to use this technology. Monzo, Starling, etc. In fact, Starling's entire technology stack is built around how we can use APIs to facilitate things to happen quicker, easier, more efficiently, and ultimately that means cheaper. Then we've got smartphones. Now, it's all very well saying we're going to get rid of branches, but if nobody has access to the banking services you have, then getting rid of branches isn't going to work because nobody's going to come to your bank because nobody's going to have access to your bank. So around this time, around 2008, as I said, pretty much everybody starts to have a smartphone. They may not have the smartphones we have now, which are essentially, as everyone keeps saying, could power Apollo 13, but they had something in their pocket that allowed them to connect to services provided from lots and lots of people, but particularly financial services providers. It meant they could check their money on the go, meant they could move money on the go, which ultimately, when you think about it, is a lot more practical than trying to get to a branch for 9 a.m. on a Monday when you really should be at work and everybody else is also at the branch trying to do the same thing. And you end up queuing in for hours and hours and hours and still probably not getting done what you need to do. Much, much easier to whip out your smartphone and do it in seconds. So the new banks that were being facilitated by this regulation were assuming or using people's smartphones in their pockets to deliver services to them without needing branches, without needing all that expensive infrastructure, which meant, again, cheaper to start a bank. And also, they had suddenly had access to a huge, huge number of people because of the internet. So they didn't, when you start a new bank and you build a few branches and you build them all in Leicester or London or Leeds or Newcastle, the number of people who can use your bank is actually quite small. When you build a bank that is accessible via smartphones, suddenly there are huge numbers, millions and millions of people who can access it instantly. And as I said again, the fourth major part here is the internet. So the internet gives you not only connectivity to your customers, it also gives you a free distribution channel. So instead, as I said, of setting up branches, paying for marketing, going out and doing things on the streets, you just put it on the internet and everybody can access it. So all of a sudden, again, you're saving costs. So if regulation is what allows you to do it, technology is how you do it. Now, the third major driver here is consumers. It's people. Now, all this is great, right? The licensee, the government says, the regulators, say, yeah, you can start a new bank. We'll let you do that. Technology says, yeah, we know how to do that. We can use that. We can build it using this. But that's no good at all if nobody wants it. So the really important final part of these drivers is consumers. And there's not that much to say here because everybody knows the answer to this. It's simply that when Google started doing what Google does, and when Apple started doing what Apple does in particular, and then you throw Amazon into the mix, everybody's expectations started to change. We now, as I said, don't want to go to a branch. We don't want to necessarily have to speak to a person, and we certainly don't want to have to wait for 9 till 5 Monday to Friday. We want it always on, we want it whenever we want it, and we want it instantly. And that was the consumer expectation, which meant they were ready for these banks that had been created by the other two drivers. Had they tried to do it, 20 years earlier, people might not have been there. They might not have trusted it. They might not have necessarily expected that, and they might still have been quite attached, in many cases, emotionally to the idea of speaking to a real person. Some people still are. But this expectation and behaviour has changed hugely in the last 20 years, and that's why it's the final, really important driver to what's changed in the UK banking market.